Happy New Year. It's great to be back with you. I hope you had a great holiday season and New Year, and I hope you accomplish all of the goals that you have set for yourself this year. I wanted to start off the show today by thanking my good friend and my business partner, Chuck Barone, who actually has his own financial YouTube show, so make sure you go check it out. But I want to thank him for his guidance and mentorship. It's been instrumental in my development as a husband, as a father, and as a business leader. I also want to give a shout out to my good friend, Gregory Manarino, who is the one who inspired me to start a real estate-based show. He's truly a great gentleman. And last but not least, my wife, who keeps everything together, which allows me to grow our family business and hopefully grow this show this year as well. So this year, I want to bring you guys some better content and information that you can find of value and hopefully apply that to your everyday life. If you guys have any questions on any topics whatsoever that you would like for me to discuss on a future show, let me know in the comments. And as usual, I'm going to start off our show with a review of last week. Wall Street saw 2023 get off to a rollicking good start as the three major indexes rallied to weekly gains when the December jobs report sparked hopes that the Fed's rate hikes are finally starting to slow the economy. The report showed wage growth moderated to 4.6% annual rate following its 4.8% decline the month prior. Add to that, the ISM non-manufacturing index reported contraction in the huge services sector. Plus, international trade data indicated weakening global demand, while factory orders came in lower than expected. The takeaway from all this bad news was the good news that the Fed could be close to pausing rate hikes. The week ended up with the Dow up 1.5%, the S&P 500 up 1.4%, and the NASDAQ up 1%. Bonds also rallied, the UMBS 5.5% up 104 to $101.06, and the 30-year fixed mortgage rate barely moved up in Freddie Mac's primary mortgage market survey. But guys, you got to remember, mortgage rates can be extremely volatile, so check with your mortgage professional for up-to-the-date information like Chuck Barone. Speaking of mortgages, conforming loan limits have increased in 2023. I'm going to break these down for you. For single-family homes in lower-cost areas, the limit is $726,200, and for high-cost areas, the limit is $1,089,300, and that goes all the way up to $1,396,800 for 4-unit properties in lower-cost areas, and just shy of $2.1 million for high-cost areas, and that's for up to 4plexes. For FHA loan limits in 2023, the limit is set to 65% of the conforming loan limit and is higher in areas where homes are more expensive. The single-family low-cost area limit for FHA financing is $472,200, and high-cost area limits are the same as the conforming loan limits at $1.089 million. The FHA low-cost limits have increased $51,350 from the 2022 limits, so a significant bump up there. Moving into construction spending, residential projects in November was a tick below October's annual rate, but 5.3% higher than a year ago. The slowdown was in single families, but multifamilies were up 2.4% for the month. Freddie Mac stated, and I quote, "Inflationary pressures are easing and should lead to lower mortgage rates in 2023. Then, I quote again, a strong job market and large demographic tailwind of millennial renters will provide support to the purchase market." Zillow reports that with the conforming loan limits going up to $1.089 million in high-cost counties, more than 2 million homes nationwide will no longer need jumbo financing, which often comes with higher credit criteria and fees. A little did you know action here. From 1971 to 2022, the average rate for a 30-year fixed mortgage was just under 8%. So today's rates are significantly below that long-term average. It's also worth noting that inventory is now 58% ahead of where it was a year ago nationally. Now, I did an end of the year housing market report for Southern Nevada, and I discussed what led to the run up and the crazy boom we had, because when COVID was first announced in February, March of 2020, we had a very normal, healthy market, 3 to 5% appreciation a year. And then sales completely dipped from April to May of 2020, and everyone is freaking out. We thought there would be some turbulence in the market there, and there definitely was for 2 months. But what happened, this perfect storm of events leading up to this crazy run we had up through second quarter of 2022, and I explained everything that led up to it, why, a lot of the factors, a lot of the variables. And I also explained where we're at today, the post-pandemic housing market. And I want you guys to have a copy of this for free. There's some great context and information in there, a lot of values, some really good charts. Go ahead and you guys click the link below so you can get this report. I want you to have it for free. It's 10 pages. It's a PDF, and the link is in the description of this video. It's absolutely free. You don't even have to enter your information. But if you do download it, hit that like button for me on the video. I would appreciate that. I also go into projections for mortgage rates and tons of other stuff that you will find of value. All right, so click that link in the description and get that report for free. Now, let's talk about some economic news. Let's talk about the job reports that came in on the economy. Now, job openings held strong despite rate hikes, and manufacturing is showing that it is in contraction. The job openings and labor turnover survey for the month of November showed available positions at 10.46 million. That's down just fractionally from October's total amount above the 10 million forecast by FactSet. As a share of the labor force, job openings remained at 6.4%, indicating demand for workers is still high despite the Fed's efforts to cool the economy and bring down inflation, which has been driven partially by rising wages. However, I would not be surprised whatsoever if this number and increases in the near future, as we are starting to see more layoffs pop up from Fortune 500 companies. I saw that Goldman Sachs may be laying off 3,600 employees. That's a major, major firm. Plus all the real estate layoffs. Compass is in an absolute disaster of a position right now. They're actually trying to rent out their Manhattan office space or sublease it so they can cut some cash flow that they're burning off the books. And I'm also curious to see as to how many of these jobs added and job openings are from lower paying seasonal jobs due to the holidays that we just had. A separate data point Wednesday showed that the U.S. manufacturing sector contracted for the second consecutive month. The ISM Manufacturing Index for December, it came in at 48.4%, representing the percentage of companies showing expansion. That was about in line with the 48.5 estimate from the Dow Jones, and a reading below 50% indicates contraction. So less than half of the businesses are expanding, albeit small, but 48% of the businesses, or 52% of businesses, are contracting in the manufacturing. The U.S. unemployment rate declined overall in December, but it rose for Black women and Hispanic men, according to the latest non-farm payrolls report. You see, Black women saw unemployment increase to 5.5% last month. That's up 0.3% from 5.2% in November. Data from the Labor Department showed Friday. Overall, Black employment held steady at 5.7%, while the unemployment rate for Black men actually declined to 5.1% from 5.4% last month. Meanwhile, Latino men saw unemployment rise to 4% in December. That's an increase of 0.4% from 3.6% the month prior. The overall unemployment rate ticked up to 4.1% from 4.0%. Unemployment among Latino women also ticked up 0.1 point from 3.7 from 3.6 to 3.7 from 3.6. Now, those figures bucked the trend in the broader economy, which showed unemployment in the United States fall to 3.5% from 3.7%. It was 0.2 percentage point below the consensus expectations from the Dow Jones. And as you know, we've been watching those Treasury bond yields, and since our last reading, the 10, 5, and 2-year have decreased slightly, and the 30-year is up fractionally. The 2-year is the highest bond yield at the moment at 4.187%, followed by the 5-year at 3.643%, the 10-year at 3.805, but the 30-year higher than the 10 at 3.643%. Now the 2-year and the 10-year spread is currently at a 68 basis point spread, and it's flattened out in this range over the past few weeks. It is still considered a large spread, indicating a possible future recession. And for the predictions this week, we have inflation, jobless claims, and consumer sentiment. Economists are predicting we will see signs of inflation leveling off, with the December Consumer Price Index, or the CPI, a Fed favorite, holding flat through core CPI, excluding volatile food and energy prices, maybe up just a tad. Initial unemployment claims should rise a bit, along with the University of Michigan consumer sentiment. All right? Now, our tip of the week, this is for those who have a goal of purchasing a home in 2023, and here are a few things that you should be focusing on. Okay, number one, very important, work on your credit. Okay, your credit score impacts your mortgage rate and future home loan. So make sure that you are monitoring your credit to keep track of your spending record and improve your score by paying down some of your debts. Number two, you need to plan for your down payment. Set aside a portion of each paycheck to go directly into your home buying fund, and work with a real estate professional like myself to explore your options for down payment assistance. Number three, get pre-approved for a mortgage, okay? A pre-approval from a lender helps you better understand what you can borrow for your home loan, so you can start to get an idea of what your numbers are or will be. And last, number four, prioritize your wants and your needs. What you're going to do is you're going to want to create a list of desired features and categorize them as must-haves or nice-to-haves to determine what is essential for you. Now, review it with your real estate agent before you search for a home, and if you're looking for a real estate agent, my contact information is below in the description of this video, and I would absolutely love the opportunity to see if it would be a good fit for us to work together towards your real estate goals. I have agents all across the country that I can refer you to if you are not in Southern Nevada. And now, to wrap up today's show, we've been watching the Federal Reserve's monetary policy very closely. We are forecasting Federal Reserve policy changes in the coming months. Wall Street is now solidly behind the idea the Fed will keep a lighter foot on the gas, hiking rates just 0.25% in the next two meetings and then holding in May. So we're going to see what happens there. Now, the current overnight Fed rate is 4.25% to 4.5%. And after the FOMAC meeting on February 1st, the consensus is for a 0.25 point rate hike to 4.5% to 4.75%, and another quarter in the March 22nd FOMAC meeting to 4.75% to 5%. And then there was a 90.8% consensus among the Wall Street bankster gangsters that the Fed will not raise rates on the May 3rd FOMAC meeting. So what do you guys think? Let me know in the comments. I hope everyone's doing well. Until next time, I'll see you then.